Hi, welcome back. Now that we've talked about investing in young growth and in mature companies, the first being growth investing, the second being value investing, let's think about investing in decline. You're saying, why would I want to invest in a company that's in decline? There might be a potential for making money off these companies. So let's set the stage. If you think about private equity and activist investors, the investor base that comes in when a company is in decline, you can trace their entry by looking across the life cycle. So if you're a startup and you're fully owned by a founder, you go to the venture capitalist, you build up to a company, in an IPO, you bring in public market investors. Initially, when you're public, the founder often owns a big stake of the company, is often the CEO. You're a growing company, the founder's stake starts to decrease, and eventually you become a mature company. In a mature company, your investors tend to be institutional investors, and founders/owners own a very small slice. Saying, so what? It is that separation between ownership and management that you see at mature public companies that can give rise to conflicts of interest between what's good for management and what's good for the shareholders of the company. That is the conflict that private equity investors and activists seek to exploit, because their point is the managers running the company don't care about you. We can find about you being the shareholders. We can find a way to deliver more value to you. So with that lead in, let's look at the trend lines for both private equity as well as activist investing. This is actually a graph that looks at leverage buyouts over time. Leverage buyouts are buyouts of publicly traded companies, obviously with a lot of debt involved. And often there is a private equity player in the midst, a KKR driving the process. And you can look across time and you can see, as with much of risk capital, the ebbs and flows of LBOs. For LBOs to grow, you need a lot of access to debt at low rates, more likely to happen in good times when default spreads are low. And you can see that there are periods where the number of LBOs drops off, but it goes up and down over time. So, not surprising. And if you look at the largest private equity investors in 2021, the top two, you might recognize the names, KKR and Blackstone. It's also worth emphasizing that both KKR and Blackstone are publicly traded companies themselves. In other words, they might have a corporate governance issue within their own companies. But even though a lot of private equity funds stay private, I think the push to go public will intensify. What's the advantage? For a private equity fund, being a publicly traded company can access capital from public market investors who are much more willing to ignore risk that is company specific. And you can see that looking at the magnitude of both KKR and Blackstone, that they're very large players in the game. Now, in terms of who they target by year or how, and this graph actually looks at activist targets by year. You can see again the numbers ebb and flow over time, but you can also see that increasingly activist targets are non-US. There was a time where activist investors were almost restricted to the US because of because of difficulties in other markets and challenging companies. Those days are done. Today, activist investors target companies around the world, including Japan, which used to be off limits. Now, in terms of the best targets, if you're a private equity investor or an activist investor, what are you looking for? First, you're looking for large positive free cash flow. Why? Because especially if you're using a lot of debt to fund your acquisition, you need cash flows to service the debt. You'd like to get these companies cheap, low price to book, low EV to EBITDA, maybe companies that the market has turned down on. And third, because the plan is to take these companies private and fix them. There has to be something to fix. You're looking for companies that have operational issues that can be fixed. Companies with lower margins than the peer group, lower returns, things that can be changed. Large cash flows, cheap, and a potential for operating improvement. Now, if you ask private equity investors why they target companies, and this is from surveys, so you got to take it with a grain of salt, they give you the reason. They say, the most common reason seems to be undervaluation, that you found the company cheap. The second is they plan to change the capital structure. The third is changing the operation of the company, changing business strategy. The fourth is they plan to sell the target to somebody else. And the fifth is changing governance. Very different motives. And in fact, when you look at the companies targeted by sector and market cap, you can see that it's across the market. So while activism has grown, it's also expanded its base beyond one or two sectors to across sectors. And the other phenomenon that I think has changed in private equity is while the early targets tended to be small market cap companies, increasingly larger market cap companies are being targeted. If you take a look at 2020, for instance, 27% of the companies targeted by private equity investors had market caps in excess of 10 billion. Tells you a little bit about how much capital private equity investors can raise, that they can take companies private that have 15, 20, $25 billion in market cap. You're saying, what do they do with these companies? Broadly speaking, there are three changes you see at these companies. The first is they redeploy assets. They sell off some assets, they buy other assets. This notion that private equity investors are rapacious, they come into targets and just sell everything and borrow more money, fits Hollywood well, but that's not what you typically see at most target firms that private equity firms have targeted. They sell some assets, they buy others. They don't systematically cut back on R&D, especially if they think R&D is their pathway to value. Are there some companies where they cut back on investment R&D? Absolutely. But those tend to be companies where there doesn't seem to be enough of a payoff from R&D and reinvestment to keep it going. Second, if you look at profit margins before and after companies are targeted, once companies are targeted in the years following they're being taken private, you do see their margins tend to improve. So when private equity targets companies, you see an improvement in profit margins relative to the peer group in the first, second, and third years after you take them. And third, the amount of leverage increases. Not by as much as legend has it. There's an increase, a fairly moderate increase in debt, though there's a subset of firms where you see much higher debt ratios. Asset redeployment, higher profitability, more debt. Now, when you look at activists come into companies and they demand things. They demand change. In this table, I've looked at some of the activist demands classified by different groups and their success rates. So, for instance, if you look at strategic and operating changes, in about 32% of the companies targeted, activists were pushing for sale of the company to a third party. They succeeded about 32% of the time as well. In about 14% of the companies, so 13.69%, they pushed for operating restructuring. They succeeded about 35% of the time. In about 10.5% of the companies, activists were pushing companies to go private. And they succeed about 40% of the time. In some companies, they target more dividends and buybacks, 15.58% of companies, and they succeed about 1/6 of the time. Relatively low percentage, they push for an increase in debt load, 4.37%. They succeed about 32% of the time. There's a set of corporate governance action they push for, where they try to remove the CEO, reduce executive compensation, and their success rate is much lower. That tells you a little bit about what managers care about the most, that those are the things that they're least likely to give on. So overall, if you look at activism, the failure rate is pretty high. About 29% of activist campaigns succeed, 71% fail. And among those activist investors who persist, less than 20% request a board seat. In other words, they stay on. Now, my pet peeve with activism, it doesn't seem to want to hang in there. It pushes for change. It doesn't really want to be involved in the continuing operation of the company in many cases. Activists are more successful, and as you saw in the previous day, in terms of pushing for operating changes than for corporate governance changes. Overall, kind of a mixed effect as you look across time. In terms of what effect activism has on companies, as with private equity, you do see a lot of asset redeployment where companies sell off businesses, sell off assets, often that they're not focused on, but that money is not paid out. It's actually reinvested in other assets. Second, there's a subset of companies, again, where you see an increase in debt ratio, moderate increase, but and a subset where the debt ratio is much larger. But again, the legend that activism pushes for huge debt ratios that you might not be able to survive is generally not true. In terms of dividend policy, there's a subset of firms where activists push for more dividends, more buybacks, and the cash return goes up, by a moderate amount. Overall, the effects of activism on companies tends to be moderate, pushes up debt ratios a little, pushes up dividends a little, redeploys assets. And there is an effect on corporate governance. The likelihood of CEO turnover increases at firms which have been targeted by activists. So when you look at companies with entrenched management, the presence of an activist, the showing up, often is a trigger for the changing of CEO, and CEO compensation does seem to decrease in the targeted firms in the years after activists take a role. I've described activists as the laxatives that markets need. I mean, nobody likes laxatives, but the reality is without laxatives, markets get constipated. So when you have activist investors, they essentially are push for change, and often that change is not liked by the existing management, but it's change that we need. Now that we've talked about what private equity does, who it targets, what activism does, and who it targets and what it tries to change, let's look at the returns to both private equity investors and activist investors. In this graph, I've looked at public equity and private equity funds. And if you look at the returns on private equity, they're surprisingly modest. In fact, you could argue that public equity delivers higher returns than private equity. The caveat here is maybe private equity is less risky. But the bottom line is private equity returns, when people think about private equity and they tar it as a villain, they assume that private equity makes money hand over fist, but it doesn't show up in the broad cross-section. And in fact, if you track private equity alphas are what you earn over and above your risk-adjusted return, it turns out private equity alphas, which used to be high 20 years ago, 25 years ago, have decreased over time. Private equity has has brought in new entrants. As the space has become more crowded, private equity investors compete with each other for deals and push up pricing. The alphas reflect it. Overall, private equity has become, like every other active investing group, a pretty average group. It doesn't deliver huge alphas, at least in the cross-section, though there are private equity players who have clearly delivered those higher alphas. As for activism, if you look across activist mutual funds, institutional investors, not much to show as success. Activist hedge funds seem to do a little better. They earn significant excess returns. And activist individuals, the Bill Ackmans, the Carl Icahns, fall somewhere in the middle. So those mutual funds that were started to be activist funds often seem to not have excess returns, partly because they don't push for much change or they don't seem to hang in there to get much change. Activist hedge funds, more likely to hang in, get change, get higher excess returns. And individual activists who might not have the cash power of hedge funds are somewhere in the middle. Now, when you look at activists, the excess returns across hedge funds and individual activists, it is positive, but there's substantial variation across the investors in the group. There are some who make very large funds, and as with VC, and this is perhaps the common feature here, the most successful of the funds, the most successful individual activists tend to have sustainable excess returns. As with VCs, where success breeds more success, in activism, you see the same kind of payoff to being successful. Now, one way to think about what happens when activists and hedge funds target a company is to look at the returns around buyouts of companies. And this graph looks at the returns, and the key date here is the date of the actual buyout. Notice first that the drift that happens, much of the increase happens before the company is actually targeted. For a variety of reasons, investors latch on that this company is likely to be targeted. You could argue it's insider information, but in general it might be because of the kinds of companies being targeted. So the price is already up when the buyout happens. But if you look at the days after the buyout announcement, there is a drift up, which either suggests a slow learning market or a market where there is risk that the buyout will be cancelled. So clearly there are excess returns to the investors who can get ahead of buyouts and then cash out at the buyout or the days after. If you look at returns on activist hedge funds again, if you look, this is an old study, 1995 through 2007, it does look like activist hedge funds have been able to deliver high returns and high alphas. But as you saw in a previous graph, that return has started to fade as the space has become more crowded. Which brings me to the last aspect of investing in decline, which I'll call vulture investing. It doesn't sound good, right? Who wants to be a carrion bird? But the reality is you're investing in companies in decline. And there are three groups of vulture investors I want to talk about. The first I call the liquidators. What do? They target a company hoping to buy it, and right after they buy it, they want to liquidate the company. What they're hoping is the value that they get from liquidation exceeds what they paid for the company. The second group I call breakup specialists. They buy a company, often in multiple businesses or having multiple assets, and then they break it up into individual parts. How do they hope to make money? That the value of the broken up parts is greater than what they paid for the aggregated company. We'll look at the basis for it and whether it works. And finally, there are people who trade around declining companies. They buy the securities of declining companies, which can include both stocks and bonds, and they try to make money by getting ahead of the distress game across So what they're betting on is as the company gets restructured, that they can cash out with a much higher price for whatever they paid for. Liquidators, breakup specialists, traders. Now, in terms of trends in vulture investing, as with private equity and activism, the trend in vulture investing is that it's getting bigger. The companies you target get bigger. So over time, you can see from this graph the number of companies targeted, but below, if you look at the top 10 spin-off deals, some very big deals in there. Vulture investing is not about just investing in small declining companies. It can be large declining companies. Now, of course, many of these declining companies, if they have debt, that debt is going to be low rated. It's high yield bonds. And there's an entire trading strategy, a trading philosophy built around playing the low rated corporate debt market. So if you look across time, this market has become bigger. There's more and more low yield debt that people can trade on, which allows them then to create strategies around the mispricing of that debt. And if you have enough of that debt floating around, you can create a fund focused just on that debt. These are distressed debt funds, and they reflect the growth in high yield securities issued by these bonds. And these distressed debt funds, again, hope to make money by finding mispricing. So let's talk a little bit about liquidation. If you're an investor, you acquire a company. If it's not in trouble right now, it doesn't have to liquidate. You can still create what's called a voluntary liquidation. What does the process look like here? You get the board of directors of the company, so you have to have enough shares to be able to get this to happen. And the board of directors basically agree to the liquidation. You hire a liquidator, the liquidator sells the assets for cash and equivalents, and usually has the legal power to act on behalf of the company. Once the assets are liquidated, you start to go down the order of obligations, senior debt, subordinated debt. And after all of those players have been paid, you get whatever's left as an equity investor. So in a voluntary liquidation, you force the liquidation process forward. There's no legal need to liquidate, but you do it. Why would you do it? Well, because you think there's going to be a payoff. Because you bought the stock for a low enough price that you think if you liquidate and pay all of the other, the claim holders, you will end up with more after the liquidation than you pay. Which means a key to success here is you can't push up the price of a declining or distressed company to a point where it's going to be difficult for you to make money. The second, we talked about in the second step of the process, the liquidator selling the assets. It's when you sell assets, there is going to be some kind of a distress cost. You're in a hurry to sell it. You have to accept a discount on value. How much of a discount is going to determine whether you walk away a winner. And finally, liquidation is more likely to succeed in target companies where the assets are pretty liquid to begin with, right? Because if you have lots of potential buyers and you can sell the assets, you'll face a much lower cost. So you have to buy at the right price, keep liquidation costs down, and hope that your assets are pretty liquid to begin with. Now, the other choice you have with a declining company, of course, is to break it up. And there are three variations you can see on these breakups. One is called a spin-off, where you take a piece of a business and you create an independent company with that piece of the business. The shareholders in the parent company will receive shares in the spun-off entity. So that's your first choice. The second is called a split-off, where basically you take a company and you break it up into individual pieces. And here shareholders have a choice of either just staying shareholders of the parent company or accepting shares in the split-off entities. Spin-off, you didn't have that choice. And finally, you have a split-up, where the parent company breaks up into two or more independent companies. And the parent company is liquidated, and the shareholders in the parent company will be given shares in all of the broken up entities. So if you own shares in GE 10 years ago, if you look at your portfolio now, you own shares in 4 different GE split up companies. That's a split up. Spin off, split off, split up. Now you might say, why would I want to break up a company that I took decades to build up? Here are the possible reasons a breakup might work in your favor. The first is you become so complicated as a company because you're in so many different businesses, the market is undervaluing your businesses. It's a market mistake. And the way you bring it to the surface is you buy the company at the market mistake price, which is too low, and then you sell off the pieces where everybody can see what the pieces are worth. The second is one or more parts of your company are contaminated and they're affecting the rest of your company. A lot of tobacco companies have divested themselves of all of their non-tobacco businesses. Altria at one point in time used to own Kraft Heinz until they discovered that the taint of the tobacco business was affecting their food business. In that case, splitting off or removing that company from the tobacco company can make both companies worth more because you no longer are bound down by that contamination effect. The third is an efficiency story, where when you built up this multi-business company, you also created layers of bureaucracy and inefficiencies. And if you somehow split the company and made it go into individual pieces, independent companies, you'd run it more efficiently. There's a simplicity story, which is you're really not going to change how you manage any of the parts, but by making the company into pieces, you're making it easier for the market to value each piece, see the value of each piece. A simpler company is more valuable than a more complex company. And finally, there might be tax benefits to breaking up. I don't know what they are, but if there are significant tax benefits, that might be a factor in breaking up. So those are the benefits, but there clearly have to be costs because these companies were built up as multi-business companies for a reason. 60 years ago or 50 years ago, 1970s, there was a push towards conglomerates. And the drive towards creating these multi-business companies were built on a couple of basic factors. One is that you got economies of scale by building a bigger company, that you could actually have lower costs as a larger company than as a larger multi-business company than as individual companies. The second is that by building this massive multi-business company, you had more access to capital and lower costs when you access that capital, whether it's equity or debt. And especially with debt, you argued it allows me to borrow money at a lower rate. This was a big basis for arguing for GE as a conglomerate in the 1980s and 90s. Look how cheaply we can borrow. Look how cheaply we can raise equity. And the third is that when you bring this multi-business company, there could be synergies across the business. So when you break up, you're removing those economies of scale, you're reducing your access to capital, increasing your costs, and you're losing those synergies. You've got to decide whether the benefits exceed the costs. Now, in terms of distress and bankruptcy, you have choices too. One is, of course, liquidation. Liquidation process where you're forced to liquidate is different from the voluntary liquidation process on 2 levels. First, rather than you as the equity investor hiring the liquidator, a court hires the liquidator. The liquidator is answerable to the bankruptcy court. And because it's court-driven, it tends to be more expensive. So it's a court-driven liquidation. The second is a reorganization where you get the different claim holders in the company and you hope to create some kind of agreement where they're all okay with this company continuing and different kinds of claims in the company. So reorganization plans, you try to keep the company going. And the third is you decide that the only way this company will survive is if it's taken over by a healthier company in the space. Because the minute that happens, the distress problems go away and maybe your operations can become more valuable. Liquidation, a reorganization, or a merger. And there are pathways to excess returns if you play your cards right. One is maybe if you can reorganize and keep the company going, it could come back. Think of the airlines. Airlines have had near-death experiences multiple times, and when they come back, they can be worth billions. The second is if it's a liquidation that the liquidated assets deliver much more in proceeds than the market was assessing as a value for the company. The third is if it's a reorganization that you happen to be one of the players who actually walks away with advantages. So when you restructure claims, there are winners and losers, and maybe you can be one of the winners. And finally, to the extent that there's a market mispricing going on when you have these complicated, you might make money by the market mispricing individual securities. Trading in distressed companies picks up around reorganization on the securities issued by the company, the stocks, the bonds, the convertible debt, where the traders are hoping to find a mispricing and make money on that mispricing. Now, if you look at spin-offs, we talked about spin-offs and split-offs. This is actually a study that looked at returns to companies after spin-offs. And basically, it compares the return to the spun-off entity versus the parent. And at least in this study, the spun-off entity emerges the winner after the spin-off, and the parent ends up losing money, which suggests that the way the spin-off was structured made parent company shareholders worse off and the spin-off shareholders better off. Finally, around distress, there is significant evidence that there's a mispricing that goes on, that both stocks and bonds tend to be underpriced. Though it's not clear whether you're fully adjusting for the risk, the truncation risk involved in these companies. So these are studies that look at risk-adjusted returns on stocks and risk-adjusted returns on bonds around the onset of the distress period. So 0 is when the distress period starts, and you can see in the months after that the returns on both stocks and bonds is positive. Now, is that an excess return? You could actually argue that these are also very risky stocks and very risky bonds, and the returns you're making justify the risk. But there's clearly money to be made in distressed securities, and that explains the existence of distress funds. So in this graph, what I've done is actually looked at equity hedge funds, corporate debt hedge funds, and distressed hedge funds. And especially if you look at the 10-year period, you find that distressed hedge funds kind of hold their own. There is money to be made in securities around distressed, and distressed hedge funds basically find a way to take advantage of mispricing. So if you look across declining companies, you might not like them as companies. They don't have much of a future. But that doesn't mean that they're off limits on investing. You can still find cheap stocks. You can still earn excess returns if you're willing to live with the uncertainty of truncation risk, the fact that these companies might not make it, which you're exposed to, just as with startups, that you're exposed to with declining companies. I hope you found this session useful, and I thank you very much for listening.